Everyone wants to know the same uncomfortable question right now. Is 2026 the year the stock market finally cracks? Or is this just another wave of fear dressed up as facts? If you've been scrolling through headlines, you've probably seen words like bubble, collapse, or inevitable crash. But here's the truth most people miss. Stock market crashes don't announce themselves politely. They whisper first. So let's slow down, ignore the noise, and actually look at what's happening beneath the surface of the US market as we move toward 2026. Historically, stock market crashes don't happen because one bad thing occurs. They happen when pressure builds quietly across multiple areas at the same time. Think of it like a bridge. One truck doesn't destroy it, but years of weight, stress, and neglect eventually do. Right now, the US market is standing on a bridge like that. Interest rates are still elevated compared to the easy money era of the 2010s. Higher rates mean borrowing costs stay expensive for companies and consumers. That slows growth, reduces spending, and squeezes profits. At the same time, government debt is sitting at historic levels, and refinancing that debt at higher rates becomes a serious burden. Then there's the labor market. It looks strong on the surface, but cracks are forming. Job growth is slowing, layoffs are becoming more selective rather than dramatic, and wage growth is cooling. That combination doesn't scream crash, but it does whisper fragility. Now let's talk about valuations, because this is where things get uncomfortable. Many major US stocks, especially in tech and AI-driven sectors, are priced for perfection. Investors are assuming future earnings will grow fast, consistently, and without interruption. History tells us that's rarely how reality behaves. In the late 1990s, it was the internet. In 2008, it was housing. Today, it's artificial intelligence, automation, and future growth stories. None of these are fake, but hype has a habit of running far ahead of fundamentals. Does that guarantee a crash in 2026? No. Markets can stay optimistic longer than people expect. But optimism becomes dangerous when it turns into complacency. Another key factor is the US consumer. For years, spending was fueled by stimulus savings and cheap credit. Those savings are mostly gone now. Credit card debt is rising. Delinquencies are ticking upward. When consumers pull back, corporate earnings feel it fast. Now here's the part most people don't talk about. The stock market doesn't need a crash to hurt investors. A long, sideways market with sharp drops and weak recoveries can quietly drain portfolios just as effectively. Psychologically, it's even worse. People panic at the bottom, sell at the wrong time, and miss recoveries. So instead of asking, will the stock market crash in 2026, a smarter question is, will the market be more volatile, more selective, and less forgiving? And the honest answer is yes. But this is where fear usually takes over, and where smart investors separate themselves. Every major downturn in US market history has created massive opportunity. Not for gamblers, not for people chasing headlines, but for those who understood risk, stayed liquid, and focused on quality. Companies with strong cash flow, real earnings, and pricing power survive storms. Speculative hype doesn't. If a crash does happen in 2026, it won't be the end of wealth. It will be a transfer of it, from emotional hands to patient ones. And if a crash doesn't happen but volatility increases, the same rule applies. Discipline wins. Overconfidence loses. So what should you actually do right now? You don't need to predict the exact year, month, or day of a crash. That's a losing game. Instead, prepare as if uncertainty is guaranteed, because it is. Diversify. Respect risk. Don't confuse a strong past performance with a guaranteed future. And most importantly, don't let fear or hype make decisions for you. The stock market in 2026 may not collapse dramatically, but it also won't be as easy as it once was. And that's the real warning most people ignore. Because markets don't punish ignorance first. They punish confidence without preparation.